So right now, with just some of the basic reporting requirements of the ACA, number one is the W-2 reporting requirement, and that is the requirement that you put the cost of health coverage on your employees' W-2s. So that's if you offer any sort of group health plan, if you offer a cafeteria plan, if you have an HRA, anything like that, you're going to have to think about this W-2 requirement. Right now, if you filed less than 250 W-2s in the prior year, you're exempt from this requirement. It's with some of the transition relief that we've been getting a lot of with the ACA, a lot of transition relief. And this one, if you filed less than 250 W-2s in a prior year, you don't have to include this information on your W-2s. But these are kind of the main four that I see employers messing up on. The first is a summary plan description. It's going to be a booklet that describes the ins and outs of your plan. Every employee has to get one of these. The penalty, if they don't, is $110 per day per employee. And I just had a client that was assessed over $10,000 in penalties for not distributing these summary plan descriptions. And the due date to give everybody a summary plan description is 90 days after they become eligible for their group health plan. So that should be number one on your list when you get back. Yeah.
Plans don't change every year, so just one time, like when it first started, or you have to give it to them every year?
Yeah, that's a really good question. You have to re-give it out, re-paper everybody after 10 years, but if there's been changes, it's 5 years. So you give it to them initially, and then good practice is just give it to everybody every 5 years again. The summary annual report is a one-sheet piece of paper that you will get probably from your insurer, and this summary annual report is due to every employee every year. So that's another thing, and it just summarizes the premiums paid on the plan and kind of the financial situation of the plan. The summary of benefits and coverage, this is that new four-page notice that summarizes the benefits provided under the plan. You have to give it to them yearly, annually, usually at open enrollment and when they become eligible for the plan. There was recent guidance on the summary of benefits and coverage because there was a lot of confusion. Employers, the way the regulations read, it wasn't clear whether the employer could ask their insurance company to provide this to their employees. And the recent guidance said that that's fine if the employer contracts, if you contract with your insurance company to provide the SBC, then your requirement to provide it has been met. So you'll want to ask your insurance company about that as well. The notice of exchange is that kind of two-sided form that you that basically informs your employees about the health insurance exchanges, and then on the back it tells the employee specifics about your plan. So it'll tell the employee whether or not they're eligible for the plan and whether or not your plan meets the minimum value and affordability requirements. Yeah.
Question on all of these requirements. If you have a standalone dental plan that the company is not part of, then do all these guidelines apply to that also?
It wouldn't if it's a standalone dental plan. Yeah, and same would go for vision. If you have a standalone vision, this doesn't apply. So the notice of exchanges you have to give out within 14 days of hire, and there is not a requirement that you give that out annually. Every year after, although I know a lot of employers do that just at the open enrollment time. So here's a kind of an overview. Like I said, it's been 5 years that we've been struggling with the ACA. Every year we've got new requirements, a new piece of the puzzle snaps into place. And so this is just an overview of of what's happened recently. In 2014, the individual mandate kicked in. Now, the individual mandate says that everybody, unless they're exempt for some reason, has to have health coverage or they'll pay a penalty. And so the way it happened is, 2014 came and went, and then when everybody was filing their tax returns, the CPAs or, TurboTax or whatever was asking about health coverage. And if you answered no, you didn't have health coverage, then with your taxes you had to pay a penalty. And so those penalties were just starting to be paid in 2015, and that requirement is continuing. We had a lot of plan designs at the end, plan design changes at the end of 2014. This was the whole, if you like your plan, you can keep it, and it turned out that you really couldn't keep it. That was that whole kerfuffle. Now we're through that, and we had open enrollment on the exchange. We all know how that went in Oregon. It went poorly. Now we're on the federal exchanges, and in 2016, they say that the exchanges are going to open up to employers with under 100 employees. And so that'll be interesting to see how that works. Just a side note on the exchanges, a lot of people ask, are these things sustainable, or is this going to actually work? And what they say now is to have a mature exchange in the United States, one that is self-sustaining and isn't kind of draining money, is when we have about 25 million people enrolled through the exchanges. Right now we have about 8. So we have a long ways to go to get these things self-sustaining, and time will tell. The 2015 was a really big year. That was the employer reporting and disclosure requirements. That's when those came into place. Now, there was some transitional relief that said if you had between 50 and 99 FTEs, so you were a mid-size employer, then you would not pay any penalties in 2015. You do have to do the large employer reporting for 2015, but you don't pay penalties. If you have over 100 FTEs, then you are subject to employer penalties for 2015. And the way it's going to work is, it's kind of like the individual mandate. The employer mandate, it goes along all year. At the end of the year, at the end of 2015 and the beginning of 2016, all of the large employers in the United States will file their tax returns, including special tax returns that we'll go over, that outlines the coverage that they offered during 2015. And at that time, the IRS is going to take those tax returns that the large employers filed, and you don't send them in with any money or anything, you just file these informational reports, basically. They're going to take those, they're going to take all of the individual returns of all of your employees, they're going to take reports that they've received from insurers, and they're going to take reports that they received from the exchanges, and they're going to put them all together, and then they're going to figure out how much everybody owes. That's the idea. And really, so that we won't be seeing notices from the IRS about how much they think employers owe until, at late 2016 at the very earliest. I really think that it'll be into 2017. The IRS will be contacting employers about penalties that they owed back in 2015. So that just makes your record keeping burden even that much higher, because it's going to be on you to refute any sort of IRS notice of penalty that would come out. But we can talk about that a little bit later. And then finally, the last little piece of healthcare reform, the one that people really dislike, is the Cadillac plan tax that's supposed to be effective 1/1/18. And we'll talk about that a little bit more too. There's been some pieces of the ACA that have been delayed and been delayed indefinitely until they give us more regulations. And these are three of them. Like I said, W-2 reporting, you're still exempt if you filed less than 250 in a prior year. This last one, non-discrimination for fully insured plans, is a really big deal because as a practical matter, most group health benefit arrangements in the U.S. are discriminatory. I'm sure many of you are aware that sometimes owners get better benefits than rank and file employees. You know, that's just kind of the way it goes. And if you have a fully insured group health plan, so you went to, Health Net and got this group health plan, and the company pays 100% for owners, but only pays 75% for employees, that's okay still. You can still do that. However, when the non-discrimination requirements of healthcare reform take effect, which they will someday, that sort of arrangement won't be permissible anymore. And so employers just have to start thinking about, okay, well, what am I going to do when I'm not able to pay for 100% of owners' policies because I don't want to pay for 100% of our staff's policies, and you just have to kind of start thinking that through. But for right now, you can still have that sort of arrangement. So recent guidance, this one, it says recent. It actually isn't that recent, but I am still blown away by the number of employers that don't know this. And it's really taken a lot of employers by surprise. And basically, before this requirement came into effect, an employer could say, I don't have a group health plan. I don't have a group health plan, but everybody, you can go out and get individual policies and then bring me the receipts and I'll reimburse you. And a lot of employers were reimbursing on a pre-tax basis. They were running it through a cafeteria plan or something like that. The employee was not picking up that reimbursement as taxable wages. That is no longer an option. You cannot reimburse employees for individual health insurance premiums. And that came as bad news to a lot of employers that don't want to offer group health plan but want to still, provide something to their employees. The one thing that you can do that the IRS says is okay is you can just raise people's wages. Just say, okay, we're not reimbursing you for your individual health plan anymore, but I'll bump your wages $200. But the thing is, you can't condition that $200 increase on them going out and getting an individual policy. It just has to be, it's like a bonus. So that's the one thing that you can do. Yeah.
What if you are the owner of a business, you have your own individual plan, the company pays for it, you're a small employer, you don't provide insurance?
Yeah. Are you an S corp, or does the owner take wages?
The owner takes wages and it shows up on their W-2.
Okay. Yeah, you can no longer do that.
And in 16 or 15?
It was actually in 14, but there was limited relief for small employers with under 50 up until June 30th of 2015. So if you were a small employer with under 50, you had to stop that kind of reimbursement by June 30th, 2015, or you owe a substantial excise tax. The tax is $100 per day per employee that you're reimbursing. It is self-reporting, so it's up to you if you want to confess your sins to the IRS and pay that substantial excise tax. Most of my clients have chosen not to, surprisingly enough. And so what I'm telling clients is just stop as soon as possible. Now, if you're an S corporation and an S corporation owner, then there is some transitional relief that allows you to not really be reimbursed, but take a deduction for individual health premiums up until the end of this year. And they're going to give us more guidance on that S corporation owner scenario sometime this fall, hopefully sooner rather than later. All right, changes to cafeteria plans. This is, they've lowered the limit on cafeteria plans. So if you have a cafeteria plan in your office, it needs to be amended. So contact your provider, have them amend it for the new limits, and also there's some optional things that kind of make cafeteria plans a little bit more user-friendly. There's a $500 carryover option now, where before cafeteria plans were use it or lose it, right? You put in $1,000, and if you don't use it in the year, you forfeit it. It goes away. But now there's a $500 carryover option where $500 of it can be carried over to the next year and carried on. So if you want that in your plan, you're going to have to amend your plan. All right, let's talk about the Cadillac plan tax. I told you before that it's a controversial provision. All of my guesses about healthcare reform have been wrong to date. But if I were to guess, I would say that this is the one piece of healthcare reform that will not take effect, that will be repealed. Even Hillary Clinton came out the other day and said she doesn't like the Cadillac plan tax. This is supposed to take effect 1/1/18, and it's an excise tax. It's a 40% excise tax on high-value healthcare arrangements. And what it's supposed to do is it's supposed to not raise money through the imposition of the excise tax, but what it's supposed to do is they think that employers will get rid of these kind of high-value healthcare arrangements, and instead they'll just pay more wages to people to kind of reimburse them for loss of their high-value health care. And because it's paid as wages, the IRS is happy because they're getting taxes on that amount. So that's the idea behind the Cadillac plan tax, is to basically get rid of those high-value plans and get everybody down to a more moderate level of health coverage. The way it works is that 40% tax is imposed in excess of the of a limit, and for self-only coverage, that limit right now, it will be adjusted in future years, but for 2018, it's going to be $10,200. So if my employer provided me with coverage that cost $11,000 a year, and that's both from what my employer paid and what I paid, but it costs $11,000 a year, then a 40% tax would be owed on the $800 that's in excess of that $10,200 limit. And for other than self-only coverage, so that's self and spouse or self and family, the limit is $27,500. Like I said, it's effective January 1, 2018, so we don't have to worry about it now, but a lot of people are talking about it. So, and it's kind of going to be administratively burdensome, like a lot of parts of this law, because it's calculated on an employee-by-employee basis. So everybody will have a different amount depending on your health care arrangement that you have at your employers. So here's just a really easy example. It's like the example I gave before. If you only have a group health plan, and premiums are $875 per month, and maybe the employee pays some of that, and maybe the employer pays some of that, you only have a group health plan, then you're just going to pay the amount that's in excess of this. So in this particular example, it's $120 would be the excise tax that's due at the end of the year. Now the question comes up is, who pays that excise tax? Is it Corey in this example, the person who's getting the coverage? It is not. It is the person who provides the coverage. So if this is a fully insured health plan, like with HealthNet, HealthNet is paying the $120. But do you think HealthNet won't really pass that cost along to you? I don't. And so I think that what we'll see is either, HealthNet either won't offer plans like this anymore, or they'll make them more expensive to the employer, so they're netting out even at the end of the day, and more is coming out of your pocket to pay the excise tax. But the reason that I say that it's going to be administratively burdensome is because it's not just group health plan premiums that is counted in the calculation. It's actually, you also have to count, if you have a cafeteria plan, you have to count both employee and employer contributions to the cafeteria plan. If you have a health reimbursement arrangement, you have to count that. If you have employees that have health savings accounts, those accounts out there where they can put their own money away in that account to pay for health expenses before their high deductible health plan kicks in, you have to count employee contributions to the HSAs. And that's why it's going to be different for every employee. Yeah.
Now, my HSA that I have is from a previous employer.
Mm-hmm.
I've just carried with me, and so there's no health benefits or anything currently with my current employer. But if I choose to still contribute to that HSA, how does that affect?
Yeah, it wouldn't affect, because your employer's doing this calculation, so they don't know what you're doing over on the side with your HSA. But if your employer's taking it out pre-tax, okay, they are.
Well, that would be an option. Yeah.
Yeah.
That would be the option I would like.
Okay, so if your employer if it is coming out pre-tax, your employer would know, obviously, because they're taking it out, and it would be included in this analysis for you. If it's an after-tax contribution, so you just get your paycheck, you're at home, you're thinking, okay, I want $100 to go into my HSA,
Something I want
then
before taxes, but
right.
It's not part of the HSA plan that's offered by that employer.
Right.
I didn't know how
It would still need to be included in this calculation if it's on a pre-tax basis. Yeah. So it's situations like that that get kind of complicated for employers. Basically, what employers need to do right now is just look at the benefits that you're offering to your employees, if you're offering any, and make a determination if this is something you're going to have to deal with or you're not going to have to deal with, and then decide what you want to do in the future. If you want to start kind of ramping back your benefits a little bit, to kind of, so it's not in 2018, it's just like, sorry everybody, you lose this great plan. Maybe you make the transition more gradual. That's what I know a lot of employers are doing. And then, like I said, this is going to come into effect in 2018. Lots of people hate this, and so it might very well go away. You just got to kind of monitor the news and information about it as time goes on. All right, the big thing: large employer penalties and reporting. So here's the general rule, and this rule, like I said, was effective for 1/1/15. Applicable large employers are subject to a penalty if one or more of their employees receives a premium assistance credit or subsidy. So that sounds pretty simple. So the first part about it is applicable large employer. What is that? And we'll kind of go through that a little bit. Hopefully everybody in this room knows whether or not they're an applicable large employer. The count is not easy for agricultural employers because you have lots of seasonals and you have temporaries and you have, contractors and leased employees, and it gets very fact specific. And I've worked with lots and lots of agricultural employers to really dive down into how to determine your status as either a small employer or a large employer for healthcare reform. So if you don't know where you stand, that's one of those things that we'll need to look at. It's not something that I can just give you a sheet of paper with rules and you can figure it out. If you have all those, leased employees, seasonal employees, temporary workers, things like that, those are really fact-specific determinations that you're probably going to have to get some help with. So again, remember, if you need to be a large employer to be subject to penalties, and one of your employees has to receive a premium assistance credit. That is the trigger for large employer penalties. So you could have 10,000 employees and not offer group health insurance to anybody, and as long as not any of them went to the exchange and got a subsidy, you would not pay any penalties. So that's the trigger that the IRS is looking for. And that's why if you're a large employer, you're going to start getting notices from the exchange when one of your employees receives a premium assistance credit. I don't think those notices have been going out yet because the exchange still is getting off the ground. I don't know. Has anybody received any notice like that? Okay, yeah, I don't think they're sending them out yet, but they will be. That's the whole point. They're going to be sending out a notice when one of your employees comes to them and gets a credit. And if you're a large employer, you care about that because that's the trigger for penalties. And so if that employee received that premium assistance credit in error, that's something that you'll want to address. And those notices that you get from the exchange will have the procedures to go through to appeal that decision. If you're a small employer and you get one of those notices, you don't really care because it's not a trigger for penalty because you're not even subject to penalties. Yeah.
I've asked a question before that no one's been able to answer. To access the exchange, do you have to be a citizen or can registered aliens access?
Registered aliens can go on the exchange. Yeah, they definitely can. I recently went on the exchange to enroll my daughter, actually, and they didn't ask about her citizenship status. So. All right, so let's talk about the applicable large employer calculation. So, like I said, this calculation is extremely fact-specific, but this is the basics. You are an applicable large employer if you have over 50 FTEs or full-time equivalents. And the way you do it is you average all the months of the prior year. So it's always just a snapshot. You take a snapshot of your size on 1/1 on January 1st of every year, and then you stay that size for the entire year. And then you take another snapshot, and then you stay that size for the next year. So that's the way it works. And you average all the months of the prior year. So when you're saying, okay, where am I on 1/1/16, you're going to look back to January of 2015, February, March, April. You're going to do monthly counts for each month. And the way you count is if you have an employee that worked 120 hours in January, they count as one, and then you add up all your ones, all your people that worked over 120 hours, and then you take everybody who worked under 120 hours, you add up all their hours together, divide by 120, and that's your equivalency number. You add it to all your ones, that's your January number. You do the same for February, you do the same for March. Then you average it out, and that's your snapshot for the year. All right? Now, one thing that I've found to be an issue with especially farms and agriculture employers is you have to think about controlled groups. And what controlled groups are is they are employers under common ownership. So if you have an owner that owns one farm here and then owns, a manufacturing business here, if he owns them both 100%, they're counted together when you're determining the status of that employer as a large employer or a small employer. And that's one thing that, that a lot of people are overlooking, especially when the businesses might not be related. You also have to look at spouses. So if you have a, you know, one farm that's, and you got to look at parents and you got to look at kids. All those relationships attribute to the other one. So if you have a parent that owns a farm and their child owns a farm, most of the time, if this child is over the age of 21, you don't have to you don't have to count them together. But if this child is over the age of 21, but also might own a small portion of the parent farm, then all of a sudden you have to count them together. Siblings, I get the question a lot about siblings. There is no attribution between siblings. So if you have two brothers that own two separate farms, you do not have to count those together unless they have ownership in each other's farms. So it's just something that you need to look at if you have controlled groups. One is called a parent and a sub-controlled group, and that's where you have somebody that owns 100% of one and 80% of the other, or 90% of one and 80% of the other. That threshold is 80. There's a different kind of controlled group that's more difficult to figure out, and that's called a brother-sister controlled group. And that's when you have common owners. You have 5 or fewer common owners that own over 60%, and they have interests of over 50%. Altogether, they have interests of over 50% in another company. So that's something that you'll just need to ask your owners about. Make sure that you're not in one of those situations. All right, so like I said, this is the way you figure it out. It's an average of the prior year. It's a snapshot. Okay, it's a snapshot on January 1st of each year. In 2014, there was when people were determining if they were a large employer or not for 2015, there was a 6-month exception where you only had to look back at any contiguous 6 months in 2014. And so I had a lot of employers that made good use of that 6-month exception for the snapshot on 1/1/15, because if you're an agricultural employer, you just choose 6 months where you had the fewest number of workers, and you could get out of being a large employer for 2015. Of course, now that we're in 2015 and people are looking ahead to their snapshot on 1/1/16, we don't have this 6-month exception anymore. And so a lot of times they'll be considered, even though they were a small employer this year, next year they'll be considered a large employer. Now I do want to talk a little bit about seasonals. And there's nothing in here, about seasonals, because it's such a fact-specific thing that I've heard a lot of health insurance brokers tell agricultural employers, you can just disregard seasonals from this calculation, and that is not true in the least. So if you have seasonals, you can only disregard them from this calculation if your season is 4 months or less. All right, so a lot of people aren't going to fit into that box, but if you do have a season, you can only disregard them if it's for 4 months or less, and the only reason you went above 50 is because of those seasonals. All right? Yeah. Yeah, they define it where the customary work duties don't extend beyond 4 months. And it has to be consecutive, yeah.
The contract laborers during that seasonal, do those get counted at all, or is that the contractor's problem?
That is another really, see, when you get down into this, there's so many ins and outs. So when you have contract labor or leased employees, the determination on who has to count them is whose common law employee they are. And the common law employee test, unfortunately, is a 20-factor test, and it's not a bright line, right? And so I have, I have some clients who are temporary agencies, and it's very difficult for them because they're like, are we the common law employer of these employees or are we not? And it's something that you have to determine, and it gets down to control. So if you have somebody that you're leasing through an agency or you're contracting with that comes and you tell them what to do every day, and you tell them how much they're going to get paid, and you tell them if they're fired, and you train them, you're probably the common law employee or employer. You're probably their employer for purposes of counting them in this. But if you go to a leasing company and you say, hey, I just need 5 guys over there, you guys supervise them, you tell them what to do, then you're probably not. So you got to kind of look at the arrangement. Yeah.
So the question I have on that is, when you're hiring a contract labor, you're telling them what you want done. You want them to come in and you want to have them do specific pruning in a specific area, negotiate the price. That's kind of a gray area.
Yeah.
You're telling their employees where to go, what to do, how to do it. You're just negotiating that up front. So what does that make you?
Right. In that situation, when you're just saying, okay, I got a general job, for 10 people over in that field, you go do that, but you're not hiring the specific workers, you're not determining how much they get paid. You're paying the company, but you're not saying, exactly what everybody's getting paid. And that company has control whether they let the people go or what they do. In that case, you are probably not the common law employer.
Firing the individual employees, not necessarily us firing the company.
Right, exactly. Yeah.
But if you come out and look at their job, what work they're doing, and say, no, you need to do it this way.
Right, even if you have a supervisor on your staff that you say, okay, go out and supervise those people, and that supervisor's telling them what to do and where to go and how to do it, then all of a sudden you're stepping into
But even if not from a ownership, just see
you can monitor the performance of the company that you hired, right? But you're not monitoring the performance of those employees. That's right, yeah. You really want to make sure that there's a very clear delineation. The other thing you want to, if you are hiring contract workers, you need to look at the contracts that you're signing with the contract laborers, because a lot of those are trying to push off responsibility for healthcare reform onto the employers that they're contracting with. And I know that because I've been doing some of those contracts. So look at the contracts very carefully. They're changing, and a lot of them will say, if I owe the IRS a penalty for any of the workers that I use on your projects, I'm going to pass that penalty along to you. And so that's something that you'll want to look for. All right, so is everybody good? Yeah.
What if you said that you don't have to count your seasonals if you use them 4 months or less?
Yeah, there's two factors. Your season is 4 months or less, and they are the only reason that you go above 50.
Okay, what if you had 2 distinct exclusive seasons because of this
I know.
this part? And so you had 4, and then 3 months later you had a season that lasted 2 months. Then is that considered 6 months of seasonals? Or?
Yeah, unfortunately, and this is an area of healthcare reform that it doesn't fit into the reality of how employers run their business. But the way it reads, it has to be 4 consecutive months and the same months. So you can't apply 4 months here to, a berry harvest and then 4 months here to Christmas trees. It has to be the same 4 months for your workforce.
If you had different crews that were working the first 4 months in berries, and then another crew that was working in Christmas trees for 6 weeks, 8 weeks, how does that figure into it?
It doesn't. You have to choose which 4 months you want to look at. So if you had your highest crew in berries,
Could they not be counted if your berries were 2 months and then in spring and then 2 months?
it has to be a consecutive 4 months. So you can't break it up. You can't say 2 months here and then 2 months there. And it's not an employee by employee basis where I'm just hired for Christmas trees, so I'm considered seasonable.
Working less than 4 months. And then they're gone. And then you have, again, later, you have them for a different crew for 2 months. Are you able to not count either of those because they're less than 4 months?
No, you'd have to count one of them. You couldn't disregard the seasonals because it's not a consecutive 4 months. It has to be consecutive 4 months. So basically you look at your employee count, right? So it goes up in berries, it goes up here, and you say, what 4 months do I want to use to, what seasonal period do I want to use to disregard those workers? So you either choose here,
So you could disregard one, but
yeah,
not the others.
or you choose here, right?
Your higher one, right?
Exactly, you pick the one that's higher, and hopefully it works out. Yeah.
Is small employers staying at 50 or is it going to 100?
Yeah, that's a good question. There's lots of talk about that.
Could you repeat the question?
Yeah, she asked if small employers are staying at 50 or if they're going to 100. So in the insurance rating industry right now, there's all this talk, and these are some of the changes that have come down about, Congress has said that for insurance rating purposes, small employer will stay at 50 and not go up to 100. And that's the same for healthcare reform. It's going to be at 50 for small employer, and those mid-size employers between 50 and 100 will be subject to penalties in 2016. All right. So, like I said, really important that you know your employer size. And here's a summary of the penalties. If you're a small employer and you were able to exclude those seasonal workers and stay under, yeah.
When you said 2016, are you talking about work year 2016 or the tax paperwork from 2015 was in 2016?
So employers that are over 100, so they took their snapshot on 1/1/15 and they were over 100, they're subject to penalties in 2015. All right, but the paperwork doesn't go in until 16. If you're between 50 and 99 on your snapshot date of 1/1/15, then you're not subject to penalties until the calendar year of 1/1/16. Okay. So this is just kind of a summary of the penalties. We're not going to go through this too much, but if you're a large employer and you offer what I call safe coverage that's affordable and meets minimum value to 95% of your full-time employees, you will not pay a penalty. You're going to be subject to all the reporting, but you're not going to pay a penalty. If you do not offer coverage to 95% of your full-time employees, you're going to pay what's called the A penalty. And that's the big penalty. That's $2,000 per full-time employee for the year. And then you get the first 30 free, so minus 30. What a lot of agricultural employers are doing, and I'd be interested to know if there's people in the room that are doing this, is that they're getting out of the A penalty by offering what's called minimum essential coverage or MEC coverage to their full-time employees. This MET coverage is not affordable, and it does not offer minimum value. It's kind of crappy insurance, and you pass along a lot of the cost to the employee, which means the employee probably won't take it because it's expensive and it reduces their take-home pay, but it gets you out of the A penalty and you're down into the B penalty, where you're only paying a penalty on the number of employees that gets a premium assistance credit. And so it greatly, vastly reduces your penalty amount, and that is what I see a lot of agricultural employers in the area doing if they're a large employer. So here's just a little bit more information on the A penalty, how to determine it, and then here's information on the B penalty again. That it's coverage that doesn't provide minimum value, so it doesn't cover a lot of things, and it's not affordable. So affordability is calculated based on 9.5% of an employee's household income. You don't know an employee's household income, so you can't calculate it that way. So the IRS said there's some safe harbors. You can use an employee's W-2 as long as you do not charge more than 9.5% of the employee's W-2 wage, then it will be considered affordable. You can also use federal poverty line, and that's what I find most people doing because it's just really easy. And basically, if you use federal poverty line and you don't charge 9.5% more than that, then it works out to be about $95 a month. If you do not charge over $95 a month for health insurance to your employees, then it's going to be deemed affordable. Right, so here's the B penalty, and that's just a summary. Let's talk a little bit about the reporting, and then I will turn it over to the fun stuff. Like I said, if you have over 50 FTEs, if you're a large employer on 1/115, you're going to have to do all the new tax forms for 2015. All right, so it's something that you'll want to gear up and get ready for, because the way that it works is that there are two reports. One is a Form 1094C, and that's the form that goes to the IRS, and it lists out all of your numbers per month of full-time employees, and this is one of the forms they're going to use to come back to you and say, okay, you owe us X number of dollars in penalties. Then there's the Form 95 or 1095C. This is an employee statement that goes to the employee with their W-2 or at the same time as at their W-2. If you are a large employer, if you have over 50 FTEs, you're required to provide the Form 1095C to all of your employees that worked any week over 30 hours. So if you had an employee that only worked 20 hours a week for the whole year and never went above 30 hours per week, you do not have to provide that employee with a 1095C. But if that employee went over for 1 week, during a busy week, went over 30, you're going to have to give them a 1095C for the year. So that's the issue with that. Yeah.
We can still do the W-2?
Mm-hmm. It can go with your W-2, and most people are going to be sending it with the W-2. Mm-hmm. It does not include seasonal employees that are in what's called a non-assessment period. And that's a seasonal employee that has not hit let's say if you have 60-day wait period for your health plan, you don't have to provide them for information in that 60 days. Also, if you have what's called a lookback policy. And a lookback policy, I'm not getting into that because we could sit here and we could talk about lookback policies for literally hours. But what lookback policies are, is they're a way of handling variable hour employees where you say, okay, you know, Joe, I've hired you and I have no idea how many hours you're going to work. So I don't know if you're a full-time employee for purposes of me offering you health coverage. So what I'm going to do is I'm going to set a measurement period and I'm going to measure your hours for that period. And then at the end of that period, I have what's called a administrative period to either enroll you in coverage or not enroll you in coverage. And then I have a stability period where you have to stay covered even if your hours drop, even if you become ineligible. That's called a lookback, the lookback method of determining full-time employees. It is very useful to a lot of employers because that measurement period can be up to 12 months. So you hire Joe, you don't know how many hours he's going to work. You can keep him out of coverage and not pay a penalty and not have to give him one of these 1095Cs for up to 12 months if you're utilizing the look-back method of determining full-time employees. It's not an easy thing to administer. It's a huge headache to figure out how to operate a look-back measurement period, but it's something that you should look at if you have a lot of variable hour employees. But to answer your question, if you have somebody that's in either the wait period, if it's a seasonal worker that's in the wait period, or in a measurement period, you don't have to provide a 1095C during that time. But if it's just a seasonal employee that you don't offer coverage to, not eligible for work, you have to, and they worked over 30 hours in a week, you have to provide them with a 1095C. The 1095C is going to say you weren't eligible for our plan, but you do still have to provide it. All right, here's the due dates. Like I said, most people are going to be putting them in with their W-2s. This is something to ask your payroll company about to see if they can help you draft these forms. Most CPAs aren't doing this stuff because they don't have information on your employees' health insurance or their situation, and so most CPAs aren't doing it, but I've seen payroll companies jump in the game. Of course they charge you for it, but that's probably the first place to look. And that's all, folks. Not hard, right? Yeah.